Let's get over to China's $1.7 trillion bond market and tell us what is going on there. You know, it's not insignificant in terms of size and depth and liquidity, 1.7 trillion. They seem to be having a bit of a hard time managing it. You know, it's gone inverted. You know, if you remember as a kid playing with something called a slinky toy, that coiled wire thing that kind of goes all over the place, that's what it reminds me of. What is going on here?
Yes, I mean, there are indeed some concerns. I mean, as you would have noticed a couple of weeks ago, we had a Moody's downgrade on the China sovereign, for example, and markets, of course, have been well aware of increased leverage in the Chinese system for some time. So this is playing through and showing its impact in the factors that you just mentioned in terms of the Chinese rates as well. On the Asia side more broadly, we continue to see good demand actually from Chinese investors for US dollar denominated bonds within Asia, and particularly of Chinese issuers. And that actually has been a key support for the US dollar based Asian corporate bond market thus far this year, and indeed already last year. Our own concern at MUFG is that some of the prices of corporate bonds now are beginning to look expensive. That's particularly true for the high yield side. So the additional return that investors are now getting for high yield corporate bonds relative to investment grade has narrowed quite substantially over the course of the past 6 to 12 months, to such an extent actually that we believe that these instruments are now looking expensive, and part of the risk factors for those indeed do include potential impact from the Chinese markets that you talked about.